the JSE all-share index selling off somewhat. It did open in positive territory today. The rand has firmed quite substantially, and I think that has something to do with the fact that the dollar did weaken somewhat, but it's really strengthened quite a lot more than was expected. So to break down why this is happening and what's happening generally on the markets, I'm joined by Michael Chen. He's from Vestax. Thanks very much for joining us as always, Michael.
Numpu, great to be here.
Good stuff. Now, what happened with the all-share index today? It opened in positive territory and then now it's in negative. What's going on?
Yeah, I think it's a bit of emotion, a bit of finding levels. I definitely think a rand being strong is playing on the index. We need to remember that more than 50% of the profits that are generated on the JSE, or basically companies that are listed on the JSE, generate more than 50% of their profits offshore. So a strong rand doesn't always translate well into what their profits are, but reached 12.98 this morning against the dollar. And would you have said that that would have been the case at the beginning of last year when we were getting to the 17 levels? So I think it's very good for the consumer just to be back down at these levels, less imported inflation, less chance of a rate hike.
Yeah, good for the consumer, but not so great, obviously, for manufacturers who are hoping for exports.
Yeah, it is a bit tough on that side of things, but currencies at the end of the day do level out, and what you more want from as a business is a stable currency as opposed to a very volatile currency. So even though we have seen the rand strengthening, it's been a slow 18 months, and the last time we were here was in, I think it was August 2015. So it has been a bit volatile, but now it's stabling out, and hopefully that remains the case. And next week we have Finance Minister stepping up and tabling his budget speech, and I think that's going to be a very big impact on what the currency looks like, a lot more so than what the SONA speech is. When you're talking tax rates, are we increasing VAT? What is our I think big thing, what does our debt to GDP number look like? What does our deficit look like? Is it higher than expected? And if that is the case, then you've got debt downgrade on the cards again, and I think you see your currency react. Are we looking better than expected? Then I think you see the currency staying at these levels.
Okay. And then looking at the US, we heard Janet Yellen, the US Fed chair, make comments yesterday saying that if she continues to receive positive economic data around the US economy, then their hand is almost going to be forced to raise rates further. Does that mean we should expect rates in March? And what does it mean for SA monetary policy?
Yeah, look, I think it's a mistake for SA monetary policy to be focusing too much on what the US is doing. I mean, it's hard enough trying to predict what our inflation is going to be, and then you want to throw the extra impact of what the US is doing. I don't think you want to be confusing those two matters. On the US front, Janet Yellen said March meeting still live, even though markets aren't really expecting a interest rate hike. But you want to see interest rates be ahead of the curve instead of behind the curve. And what that means is that you're raising interest rates ahead of when inflation, because if inflation breaches that 2% mark, then you have to raise interest rates very quickly, and that's damaging to economies. So it takes probably about 18 months, 12 months to 18 months for an interest rate hike to fully be processed through the system, and you almost want to be ahead of the inflation curve by that margin. So even though at the moment you're seeing a lot of low inflation in the US, you're seeing the jobs numbers, and they basically at full employment. So on that side of things, the economy is looking very healthy. So she's saying, look, let's push a few interest rate hikes through so that when inflation does start heating up, at least we're ahead of that curve.
Let's stick with SA monetary policy. The reason why I mentioned SA monetary policy on the back of US monetary policy is that many analysts do say that as much as the Reserve Bank won't say it, they do look at what's happening in the US, because if the US raise rates, then it means investors will take their money out of South African bonds and other emerging market bonds and go to where they feel there's a higher yield. So that's the first thing. And then the second issue is that we've seen inflation come out, inflation data come out for January. That was up 6.6% vis-a-vis 6.8% in December. It's slowed somewhat, but it's still above that 3 to 6% Reserve Bank target. So what do you expect is going to happen with monetary policy?
Yeah, I think you still stay the same in the next meeting. We're moving in the right direction. A big aspect of our 6.6% was food inflation at close to 12%. And a big part of that was 17% in breads and cereals, and that's direct translation from the drought, and that's now been over. So there's future inputs in inflation. We've got a very strong currency at the moment, so you're not going to import inflation like we have in previous years. The drought's over, so you're not getting that inflation from your grains inputs into it. So I think same rates. As far as investors go in terms of the currency, look, I think there's a big case to be made that people invest in South Africa more for the growth of the economy than for the yield on our bonds. And it's always a balancing act. So there's definitely people investing for the yield on our bonds, but there's a group that's investing for growth in the South African economy. And by raising interest rates to try to compete with the US, you get to a point where you're scaring the one investor away. And also, we don't know exactly what the US is going to do. You rewind 2 years ago where the Reserve Bank basically raised rates because they assumed that the US was going to raise rates at their next meeting. It was another 12 months until the US actually did raise rates. So we tried to preempt what the US was going to do, and it wasn't great for us. So I think trying to forecast what other reserve banks are going to do is a mistake. We need to focus on what our mandate is, and that creates clarity of policy. It creates certainty for markets, and when you've got stability, it creates investment, and that's good for an economy.
Okay, super. Well, I have a next question, but we've run out of time. Thanks very much, Michael. Unfortunately, we've run out of time, but that was Michael Cho, and he's from Vestact.